Okay, so I was just picking a few points up from Simon, which I thought was always a good talk, and interesting looking at it from our perspective on the insolvency side. Of course, we don't have retained clients because we have to get new clients every time. So we don't have that benefit of having a book at the end of the year of clients. So we are constantly doing all the things Simon's talking about there, every day trying to make sure the phone's ringing for us to keep ourselves out of trouble. Now, one of the key things that I think comes through from Simon's talk there is the aspect of customer service, because if your customer service is right for your clients, then all the things we're going to talk about over the course of the next half an hour are relevant to you, because it means that you want clients to come and talk to you if they have a problem. If the shutters are down and the barrier's there saying, please don't come and bother me with something that is not my standard issue stuff, they're not going to come to you. And probably one of the biggest things we see at the moment in terms of what we do is that mix of work coming through direct from clients and coming through professional advisors, accountants, etc. from that side. So we're seeing a consistent increase, percentage-wise, of more work coming directly to us. Now, that, not always, but I think to a certain extent, can be through a lack of relationship with their accountant in the first place. And that comes down to, from my view, that initial engagement you have with a client in the first place. So, if you have an engagement letter, which I'm sure you all do have, and that relates 10 pages of all sorts of stuff that means nothing to anyone, no one ever reads, that's fine. Is there scope then for some sort of more open, more soft touch terms of engagement to say, I will do this for you, it will cost you this much, we'll do that for you, it will cost you this much, etc., etc. So they have some sort of understanding what to expect from them. Because what we see from pretty much every client that comes to us direct, they will say, we were not happy with our accountant. And they'll often blame the accountant, I know it's a bit of a blame game, but they'll often blame the accountant for the fact they didn't get this, they never had that, it was too expensive, they didn't know all these different things. And that must come down to a lack of understanding of what the relationship was from day one. So what were you doing for them? What were they doing for you? How much was it going to cost? All those issues have an impact on that. That's probably one of the biggest observation we're seeing at the moment, is that swing around still there, that mix of those two types of work coming through. And I think it's down to almost what you set yourself out to do. So we do a number of talks in this sort of area, and it's interesting. Some people say, I don't want a client to contact me. I don't want people giving me a call about questions that are not my general core area. The flip side of that is you say, well, I've got a whole range of different services I could help you with. And I'd like to help you with. I can't do it myself, but I could refer you to this, I could refer you to that, I could do this for you. And it's a totally different approach to how you want to go about it. So that's not for me or anyone here to tell you what you should do from that perspective. But of course, if you are wanting clients to come to you with questions, problems, issues, then the issues we're going to go on and talk about today are spot on, because they are going to come to you with questions that relate to cash flow issues, potential pressure in the business, that type of stuff. And they're all sorts of things actually that are going to be important from that perspective. So it's down to how you want to set yourself out from day one as to what you want from your client, or whether they're going to come to you with some of the issues we're going to talk about today. So just for my own benefit, would you say between yourselves you would have mostly business clients, some business, some half and half, less than that?
70-30.
70-30, so, and when I say business clients, would you include sole traders in the business clients? Would you say 70% would include sole traders? Well, sole traders compared to limited companies, 20%, 25%, a bit less?
Yeah, in that order.
Yeah, that sort of mix, okay. And if someone's coming to you now, just wanting to start a business, are you recommending limited company to them? What format are you saying is the best thing for them to do? Is it every client's different, or is there a set sort of principle? So it very much depends what they're looking to do. Okay. And would I be right to think that some of you might have some sole trader clients who are running quite big businesses? Yeah, so there is different aspects to that. Of course, that has an impact if things were to go wrong. That impacts upon them in a different way compared to being a limited company to being a sole trader. So I'll look at some of the statistics on that in a minute to see what it's all about. Let's try and get this first button on here working. There we go. So the insolvency update, which is part of what we're just talking about now, because I want to talk to you a bit about some of the stuff that we see at the moment and how that might be relevant to what you might see and how that ties in what you guys are seeing. And also then a little bit about pre-pack administration, because some proposed changes coming through on that front, and that's quite interesting, for me anyway. So have a look at that, we'll chat about that. And then the members liquidations, which I'm sure you're all seeing more of as well, but again, just touch on that again towards the end if you can do. Okay. So, get the right button there. Now you might want to look at your slides for this one because it's an infographic which just picks out the latest sort of quarter two, so the last set of figures come every 3 months, so end of March, end of June, etc. The next ones aren't out at the end of September, so we haven't got those at the moment. Now, that's a kind of very compact view of the various changes in the marketplace. I don't want to take you through it in too much detail, I just want to talk through it around as a base. So, what we have seen generally is a continuing drop in the level of corporate insolvency over the last few years. In fact, the last quarter was the lowest figure since 1984. So you're seeing quite a big drop. You know, if you go back to 84, it's quite a few years ago. I just about remember it. So it's quite a long time ago from that perspective. I mean, would you say in terms of performance with your own clients, you're seeing improvements in general profitability? Is that coming through a little bit generally?
Yeah.
Sectorial? So you say, are there certain sectors that just haven't come out of recession yet? Were there any sectors you'd point out and say particularly are not doing as well as you'd hope them to?
Accountancy.
That's another talk. I'll get Simon back for that one. But no, it's interesting because the first time this year, or this quarter, the Insolvency Service released some statistics per industry sector. They've never done that before, so they've actually broken it down to industry sector. They've done a comparison. That goes back to quarter one rather than quarter two, but it just runs that through. But it's showing there construction's one of the highest areas of insolvency still from that perspective, which is probably not a big surprise because you look at the huge amount of businesses working in that sector. You're seeing growth in the sort of administrative support service, but of course, again, that's a big increasing service as well. The whole service sector is something we rely on so much now as a country from that perspective coming through there. So things are pulling up from that perspective. But if we just sort of stick on the sort of the company side, we are seeing, although we're seeing a slowing in the voluntary liquidation, so the creditors' voluntary liquidation. So would you all be familiar with the idea of a creditors' voluntary liquidation? So it's the voluntary option to liquidate a company basically. So it's usually the end of the road for a company from that perspective. Although the rates of those are dropping, interestingly, in compulsory liquidation, so the liquidations where people are being pushed into liquidation by a creditor, are actually not slowing as fast as that. So exactly what you read out of that, other than to say, I guess people are not jumping as soon as they might do. So the problems perhaps are deeper when they get there, because if you imagine a situation where a client comes to us and we're saying to them, well, what you probably need is an insolvent liquidation, it's going to cost you X, and they say we have no assets whatsoever, the likelihood is going to wait till somebody, HMRC for example, forces them into compulsory liquidation. I think what we're seeing underlying that is the fact that some of the companies coming to the end of their life have got nothing left in them whatsoever. But I think that's a reflection of the fact that there is the service industry sector, of course, which doesn't generally have an asset base in it. And I suppose in a similar way, many construction businesses, you look at the smaller construction businesses, they're hiring most of the stuff they've got as well. So you're not really seeing a huge amount of asset base in there. So I think that's where we're seeing the growth in compulsories a little bit, because they haven't got the money to put themselves into voluntary liquidation, and they're waiting to be pushed in by someone from that perspective. Okay. Just jumping around a little bit, in terms of some of the, how best to describe this really, some of the problem areas we're seeing at the moment, sorry I mixed this in a bit, but one of the issues we're seeing more and more of at the minute, which is a concern from our side, and I think some of you may be able to do something about, is the issue with a 50-50 company. So you've got two shareholders coming together in the first place, setting it up, and they get to a problem and they can't decide what to do with themselves, and they're falling out. So if there's any means by which we could try and sort of encourage a new start business to say, well, there ought to be at least a controlling shareholder in there somewhere, at least a resolution is available to them. And this is applicable both in husband and wife business, so you've got a marital breakup, or down to two partners coming together, or three or four partners coming together to set a business up, and they fall out, and it just blows up. And the problem is with that, it really is very, very difficult to resolve that situation, because of course someone says, well, I'll buy your half off you, and of course the figure they're offering is half of what the guy thinks is worth, and vice versa, and so it becomes a very difficult situation to come through from that side. Do you see that very often? Do you see many these sort of 50-50 companies? Is that still the general norm coming through?
It's called marriage, isn't it?
Attractive that way, lost, but that is seemingly, that's probably the biggest problem we see at the moment, because in those situations, particularly if it was a married couple, for example, I'm not suggesting you could tell people there's a risk involved in getting married, of course, be careful what I say, but these issues are virtually unresolvable at that point in time. And that's a nightmare situation. Sit there and say, well, we can help you, but the needs of this, this and this. And of course, because these two parties often aren't talking to each other, I'm not just talking about marriage here, but I'm talking about business partners. You know, we've had grown men sit in a room together and won't say two words to each other. Turn their back on each other. You think to yourself, hang on a minute, you're 40, 50 years old, and he's sitting there like a 2-year-old. But that's what you get. These breakdowns get to that extent, unfortunately. It gets so childish, if you want to call it that. I mean, you know, principle-based, I suppose, but that is not a great place to be. So just have that in mind if you can do. If there's any way of sort of saying, can we have at least a casting vote or some way around that, it's going to give you a bit more flexibility in those situations for a fast resolution rather than very slow, painful resolution of that situation.
Isn't the problem, though, determining who has the casting vote? I mean,
well,
if you're in 50-50, no one's going to give it up.
Well, this is the question, but in the first place, when they're setting it up in the first place, the hope is that they would be able to make that decision between them. The difficulty is, once they're all in the middle of it, you have a situation, well, I did all the work, no, I did all the work, I did all the work, and it goes on and there's no resolution to it. So the only chance of resolving that, I think, is at the very beginning to say, look, this is general, good idea to have an owner, general, you know, a principal in the business to take that forward in some way, and that's something to talk about, I think, from that side. So, but again, it's an issue that's coming up more and more from our side. In terms of our marketplace, overall, again, coming up more and more at the moment is personal guarantees. If you've got clients working in the construction sector, we're seeing people having signed personal guarantees with the likes of the big suppliers, not mentioning any names, and they're not realising they've signed a personal guarantee. They're actually what they're doing, they're thinking they're signing a credit agreement, but actually what they're doing is signing a personal guarantee. So it's certainly worth, if you're talking to construction clients, making sure if they know if they've given a personal guarantee to any of their suppliers. Well, it's interesting. I would have thought that was the case. It's not proven to be the case. People, because they're saying it's a business relationship, you sign the paperwork, they seem to be successful in taking this through. So we've tried a few times to get people to represent clients to protect themselves against the personal guarantee once it's come. But they say because we've gone through it so many times now, and we've been successful in claiming the personal guarantee, it's getting through.
No, the banks insisted on particularly advising wives and husbands who committed the house to the wives normally had to sign in front of the...
Yeah, I think if you look at where that comes from, is that, let's say in that situation, you've got a husband or wife, and let's say the husband or wife is not involved in the business, that's where that problem came from. There was a case probably going back 5-6 years ago whereby there was a husband-wife team. The wife said, well, actually, I didn't know what I was signing, I was never involved in the business, and the court held basically that they couldn't have her half of the house because she wasn't involved in the business, therefore it was never used for her benefit. So that's a slightly different piece of case law around that, but the principle is still the same. So yeah, it's a question of understanding what's being signed. And I guess we all try and do that, but it's something that will come up from time to time that we will perhaps miss out on going through that. Just flick back to stats so we don't get too over the time. So say we've seen this lowest level since 1984. Closed volume liquidations are on the way down more and more, which is always very painful for us, of course. That's what we do mostly, so that's a painful aspect from there. As I say, general corporate's gone down, administrations and company volumes are arrangements dropping as well, so the whole thing's coming down within that perspective. If you look at that, you know, 34%, nearly 35% drop in administrations, you've got an idea that that's not just affecting the small end of the market as well. You know, that's going across the whole range of businesses. Now, that's hopefully a positive sign from that point of view. The personal stuff, which is quite interesting, that's why I was interested in what sort of split you have in the sole traders versus limited companies in operation, excuse me. Because what's within the stats at the moment is showing we're seeing a decline in bankruptcy generally, but we're seeing an increase in the IVA, the voluntary arrangements. Now, partly that's because it's still been very well sold, so it's been marketed very hard as a better alternative to bankruptcy, and so it's been pushed very hard to people, consumers in that situation, which is causing the growth in that, I think, in part, but I think also underlies that although we're seeing some bubbling of benefit and growth in the business sector, I think there's still a huge amount of unresolved personal debt out there from that perspective.
On the IVAs, often those agreements run for something like 5 years.
Yes.
Are they generally enforced? What happens when people don't meet them? Do people generally stick to? I mean, they've been bad payers up to that point, presumably.
Yeah. So an IVA agreement, just in those that couldn't hear all that, but basically you've got most consumer IVAs. There are a variety of different IVAs you can put in place. So that's an individual voluntary arrangement. Basically, will often last about 5 years. So what happens if that fails partway through? it is possible actually to go back to the creditors and say, can we make a variation on that? So could we change that possibly, the terms of this because of A, B and C? But if actually the IVA fails and the individual doesn't keep up their payments, they're under bankruptcy anyway. That's why, now basically what has to be in the proposal is that sufficient funds are kept to one side to pay for the bankruptcy of the individual. So in other words, they're trapped into that situation. So that's where, again, I'm not always totally convinced the IVA is the thing to push, Jonathan, because sometimes bankruptcy can be a very good, quick resolution to a situation, and it takes the problem out of the way. Partly depends, and again, I don't strong views on this, but it partly depends for me, sometimes the age profile individual involved, because if they're perhaps coming towards the end of their career, they might say, well, I'll take bankruptcy, it's not a problem. But if someone's in the early mid-20s or early 30s and they've got to put themselves through bankruptcy, and that's going to almost be with them for the rest of their business life, then there is often, I think, some benefit for working harder to try and put some sort of IVA structure together, or even an informal arrangement together to try and work around that, because that is quite a burden to carry, because that box always have to be ticked saying, yes, I was bankrupt, yes, I was bankrupt. That's going to be with them forever, basically. So that's the balance there. So it's partly down to age profile, partly down to asset situation.
Can I just ask a question? A client asked me the other day, because I suspect there are a lot of, with lots of young people at the moment who've got student loans.
Oh, I need to ask this one.
Yeah, and they've asked me this. They've asked me the question: do you go into bankruptcy, or this person may not work? A lady who she's now got children. Can the parameters be? Could they be altered by the government retrospectively? Could she be forced to pay the loan? It's rising.
There's different sort of takes on this situation. You perhaps get different advice from different people, so I'm going to cage this quite carefully, because some people will say they will survive bankruptcy, some people will say they won't survive bankruptcy. Now that sounds like a strange thing to say, but it seems to be slightly different for different people, depends who's looking at it. So I think it's one to sort of pin down more precisely for that client, rather than otherwise within that. But they can't retrospectively come back to it. But what was happening was, it can be deemed as something that survives bankruptcy, a debt survives bankruptcy. So there are certain things which say fines, etc. There's certain criminal offences where the fine will survive the bankruptcy, so going bankrupt doesn't get rid of that debt. So that's a bit of a grey area as to whether that would or would not be successful in getting that through there. But they wouldn't say you've bankrupted your house and then come back to you again 3 years' time for it. It's just a question of whether it survives bankruptcy in the first place. So is it a provable debt in bankruptcy is the question. If that managed to step around that question.
It's a huge issue, really. If you really think it's potentially a huge issue.
It is. I mean, it's, I was fortunate to be before that stage where we were all being funded to go to university, etc. But from the point of view of those loans are there, they're significant figures. Now there isn't any stats in terms available at the moment in terms of what the age profile is of people going to bankruptcy. Because of course you could find a situation where actually they are quite young, but we don't know because the stats aren't there to tell us what it is. But it's interesting to see through. But I think bankruptcy is it does a very good job. Well, it's a bit Dickensian as a principle, but then the law's not really changed since back to then. You step away from all your debts, leave the problem behind, walk off you go. And I guess it can be quite an appealing idea for someone quite young because they haven't got an asset base, they perhaps haven't got a property, they might have a family, therefore it seems perhaps more appealing at that age to do it, if that's what they think is the right thing to do. It's more complicated, of course, if you've got a marital home, where you might have a half share of a property, you could potentially have joint borrowing, so husband and wife could have the same on a credit card, for example, it could be separate, and it gets a bit more complicated to work out the best plan for them there. So, in terms of that comparison of whether an IVA or bankruptcy is the way to go, I think it's very much down to a per-client discussion, depending on what they're looking at in that situation. But, the answer usually drops out, because I'll take a couple of examples recently I've been talking to. Both have got significant tax debts, both running sole tradership businesses. One's reason for having a problem was that the accountant they were using seemingly didn't know what they were doing. Now this is strange on this one because I saw the letterhead in all fairness. It was a lady and it said ABC, what her name was, in brackets, chartered accountant. So it didn't say FCA or ACA or any of those sort of things, just brackets, chartered accountant. So they perceived that she was a chartered accountant and therefore she must know what she's doing. And she showed me some of the papers that this lady I was talking to gave me some of the papers that the accountant had given them. They were just almost like fag packets with a few numbers on it, and that was the accounts apparently. I thought, you might have been slightly suspicious of that at that point in time, but it seemed that she wasn't concerned about that. But she did eventually contact the chartered accountant, ICAW, and found out that she certainly wasn't a chartered accountant, and no one actually knows what she is, and she seems to have disappeared as well. But she was doing the tax returns, this lady, and she kept saying, no, you're fine, we're paying all this, you're fine, you're fine, you're fine. She's come back with a 5 years worth of significant trading liability for corporation tax, except not corporation, personal tax, etc., on the basis of her income over this period of time. And she's sitting there going, well, where am I going to find 60 grand from? You know, in a similar situation, a chap who was, he just didn't do his accounts, I don't think, basically. He's gone to another accountant who's found his figures and said, right, we've got some issues here, let's have a look at this. But the same issues there, that these are just very long-standing issues in the background there. So every situation is a bit different, but it's quite an interesting area to work in, because to a certain extent, the corporate situation is quite easy to resolve, because it's rescue, it's liquidation, it's administration, it's CVA, the options there are quite clear. It's more difficult on the personal side, so of course you're moving into some more deep issues. If you've got family living in a house, you've got marital homes, etc., so it gets more complicated there. But it's quite an interesting area to work in. I've got 10 minutes, so we're going to get through, Simon. Don't worry. Coffee won't go. I reckon I've got 12 minutes, by the way, Simon. You'll look at a different clock than me.
I gave you 20% more. Yeah.
Okay, go the right way, so I know where that. Okay, so we'll talk a bit about this at the moment anyway. Pre-pack administrations, let's do just a couple of minutes on this. It's quite interesting. A report was commissioned by a lady called Teresa Graham, who is a regulatory specialist, I believe, so she tells me. And it's interesting because what they're trying to do, would you all be comfortable with what a pre-pack administration is? So basically it's the idea that we're going to take a business and sell it immediately the administrator is appointed. So in other words, there is no trading. So if I make a distinction there between a trading administration where an administrator such as yourself goes in there and runs the business for a period of time, versus a pre-pack administration where basically we never run the business. We are involved in arranging the pre-pack in the first place, but not involved in running the business. And so there is a significant difference in cost in doing that. Now, most of the issues around the pre-pack come down to the question of marketing of that business. And has it been properly marketed? Has it been properly made available to the general public? So some of the issues that's come back from Teresa Graham have been, yes, there are some benefits. You know, sometimes you preserve jobs. So if you look at, is it phones for you at the moment? They're going to save some jobs because not in the same company, but other people are going to take those on, albeit in a slightly different way. You know, it's not been pre-packed per se, but the principle's there in the same way. It is cheaper than the trading administration. The pre-packs, of course, you're not paying someone to run the business for you for a period of time, and the business carries on trading its steps from one company to the next company, literally overnight in those situations. Negative public perception. Now, you know, I'm sure if you took a straw poll in here, you may have a completely different view about whether you think a pre-pack's a good thing or a bad thing. Is it a good thing or a bad thing? What do you think? Bad. Generally bad?
Yep.
Anyone had a client gone through it? Was it good?
Yeah, for the client, yeah.
That's interesting. So you've given me a perfect example. It depends where you stand, what your perspective you're looking at it from, as to whether it's a good or bad thing. And if you look at it as a creditor, of course, you're going to think it's a bad thing. If you look at it as a supplier who might then work with that company for the next 10 years, you think, well, that's a good thing. If you're an employee, you might think it's a good thing. But you know, if you're losing out from it, it's going to be a bad thing. If you're winning from it, it's a good thing. And that's the perception, unfortunately, is that the biggest issue really here is I think that if a company goes into administration, they're not insolvent because of the administration, they're insolvent before the administration. So they are, by their nature, the debt that already exists before we get involved. That money is already lost before that position is involved. And unfortunately, the process is blamed for that to a certain extent, rather than necessarily the fact that problem's come in the first place. Now, I'm pretty open to this. It's just the legislation we deal with, so I'm not going to sit on either side of the fence on this one. But it's interesting to look at the comparison. But certainly, people have been very vocal about unhappiness about losing out from the insolvency of the company. Now, you have to be a bit careful here, because then you start questioning the whole idea of having limited companies. You say, well, I don't want to have a limited company because I don't want people not having protected liability. And so it's quite a big area. You can see just a few faces there. You can see that it creates a very different view from different people as a structure. Sorry.
Competitive bids. Once the pre-packs agreed, should then be a period of say 2 weeks, then counter bids can be made. Because sometimes, you know, if you look at the timing, frequently the timing is just when the rates will be due, just when the VAT is due,
Yes.
just when the PAY is due. So all those bits go out.
Well, I think the issue over the marketing is a key point. And I think it's quite clear that there are firms that there are firms that are not marketing the business at the moment, which is one of the problems. So I'll just flick through the recommendations very quickly in the next one. One of the things is the business must be marketed. It must be marketed by a professional agent with professional indemnity insurance. I'll come on to that in a second. But the principle there, I don't think you can really do a pre-pack and not market it at all. I think that would be a bad thing, personally. So, we work with agents ourselves to market the business properly and make sure that's done correctly. The reality is, the smaller the business, the less buyers there'll be. Because the people who know the business, the ones that work in there, they're going to pay more for it than somebody who doesn't know the business, because it's all risk otherwise. So the size and the scale will perhaps affect how broadly people are interested. I mean, we advertised the business 3 or 4 weeks ago. We had about 10 interested parties going forward. None of them actually bought in the end, shamefully, but they got some quite serious looks at it, and they were quite big businesses actually interested in buying quite a small business. Thought it was interesting. So the careers Graham has suggested we have a pre-pack pool, which is basically a pool of external professional advisors who a pre-pack would be presented to for their approval. Now, it's not been said how this is going to be put together or anything. I think at the moment the various sort of insolvency-related professional bodies, etc., are trying to work out how this will work. But the idea is that you would pay a fee to the pre-pack pool. They'll have half a day or so to review that and say, is this a fair transaction? Part of that review is also there must be a viability study on the new company. So they must explain why that new company is going to work now. It wasn't working before. So, they're very sensible issues, without a doubt. The issue, I think, really is the timing issue and the cost involved in doing so. But those issues have not been resolved yet, so we're a bit kind of grey on how exactly it's going to pan out. There is some points of information on there. So there's going to be a redraft of 616 again. So something else we can read. Look forward to that. So that was exciting stuff. Must have marketing. There's 6 key principles. I won't go through those now. Excuse me, running slightly short on time. Must have a professional indemnity insurance advisor. And must make sure that basically what's happening at the moment is that the Insolvency Service are reviewing all the pre-pack deals to make sure they're right. They're now saying they should be monitored by the supervisory bodies, so ICAW, IPA, all those sort of bodies like that. Might have to look at that. So there is talk of change to that. The jury's out, I think, for me, having read through the report in some detail, because I'm keen like that. And what was interesting, I'm keen. But no, they had. What my concern is principally that the main comparison that was made in the report was between a trading administration and a pre-pack. The correct comparison is between a pre-pack and a liquidation, because actually there is no scope to trade a company with no money in it. So actually the comparison is different. So I think the basis of the report perhaps misses some of the fundamental issues for the market that uses that most. So it's the sort of SME businesses use the admins more than anything else. So that's the kind of issue there that I think there's and it's difficult for someone coming in from outside the industry expecting to be an industry expert in 5 days. It doesn't work like that, unfortunately. So, but again, I think probably what the conversation was, they probably had a quick chat with KPMG and a quick chat with Price Waterhouse, said this is what we do, that'll do. And didn't talk about the small guys like ourselves who are dealing with it day to day in a much different sort of style of capacity. But either way, we'll get dragged into it, and as and when that evolves further, we'll tell you more about it as it comes through. But it's certainly changing. I think, judging from the reaction here today, that should be a positive thing if something's being done. Not necessarily the right thing, but if something's being done, I think that will be seen as a good thing within the sector. Just quickly on the members' voluntary liquidation. Have you all had cause to use a members' voluntary liquidation in the last 12 months or so?
Yes.
Everyone know what it is?
Yes.
That's good news, excellent. So, do you have any difficulty in convincing a client that they should use a members' voluntary liquidation? No? Do they see, what always makes me, slightly concerned, it's called a liquidation in the first place, but also it's under the Insolvency Act. So some clients definitely are asking us, is this going to affect my credit rating, all that sort of thing, which are natural questions if someone's going to talk about going into liquidation, but they don't necessarily understand the ins and outs of that process. But I think it's definitely an area that is, obviously we're seeing growth from that side. I think the statistics aren't quite complete this year yet, because we haven't quite finished the year through, but we're seeing something like a 50-60% growth in numbers of members liquidations going across the UK at this point in time. So it's definitely a growing tool to use in that perspective. One of the key things we find is that the directors understand we want their money out, shareholders want their money out very quickly. And so that's part of the planning. So the only thing I mentioned to the members in particular is to make sure thought is given before it actually happens into what's the best way to get the cash available, assuming this is sort of a contractor type members liquidation, how that cash is best available to the shareholders immediately. So that can be through, we tend to work with the tax advisors, we don't do tax advice, to work out in each individual situation how it's best done. Sometimes it's done through a loan account, so money's gone out before. Sometimes it's held with a third-party advisor, accountants, solicitors, for example. So the main issue is if we have to write to the bank once we're appointed and say we'd like to have access to this account, we'd like you to send the money over to us, you could potentially look at 2 months before the money comes back to us. before we can pay it out. So if it's sat in a client account somewhere else that can be shipped out straight away, that's a very positive thing. And of course, for all of us, your client's happier because the money's in their bank account, not anyone else's, which is where they always want it. So just have that in the back of your mind, that the planning is actually almost as important as the actual process itself, to make sure that's given that enough thought to what's going to concern them the most. The risk area for them is they're going to worry about that money. Okay. Clearances is still an issue. It can take a while to get clearances through. So that's why we try and get as much stuff done again in advance, working with yourselves to get those clearances in, any accounts done, all that sort of thing. So again, there's quite a lot of planning to do. I mean, I would have thought there's quite a lot of work for you guys and get all that together. And a decent fee, I would have thought, in terms of your perspective, you're probably getting as much as we are out of doing the members liquidation, because of the work you need to do to prepare all that to get it together. Do you any of you have a set fee for that, or do you just work out as you need it?
Depends on the amount of work, doesn't it?
Yeah, depends on the size of the client. Yeah. Okay, so I think you're still earning for it, you're still making money out of it from that perspective. Okay, good. I think we all know why people might use a members liquidation, that's good, but, you know, anyone seen any particular bizarre reasons for members liquidation recently? Anything unusual?
Have we seen a lot more from the contractor sector? Because we have lots of contractor clients whose a year contract may be up, and significant amounts of money got built up in the bank. Is this the way they're going now?
Certainly seen, if you look at the oil and gas industry, for example, so they're going off to work for 12 months in Dubai, for example, they come back with a lump of cash. You know, the issue can, this is a bit cursory here, because I'm not a tax advisor, and clearly there is anti-avoidance legislation in place to protect against this being done incorrectly, so that's where we cage ourselves quite carefully to make sure, although we can transact it, we wouldn't be telling people this is appropriate for you in this circumstance. But yes, I think it's down to them really having a good reason to change what they're doing, their trading style, they're going back into work, you know, PAYE, etc. Those sort of things, as a company coming to a close as a business, they're things that would lead to that being necessary to do it. But yeah, I think it's got to be looked at on a per client basis with an eye to making sure it's not towards our trust.
If the contract specifically ends, is that not is that going to be the end of the company? As it works,
depends on if they're about to turn around and do another contract in the same sector in the same thing, then I'm guessing the argument would be that's not a good reason to do it. I suppose it depends what they're up to. If they're going to get a job somewhere else or go and be a lifeguard in the Bahamas for 6 months, you know, I think that would probably be a different sort of structure. So yes, I mentioned costs, just to make sure not being caught in there. Members liquidations in particular, I think it's important not to overpay for those, but you are looking at about £2,000 for a members liquidation, a cash-based members liquidation. There would be VAT on top of that if they're not VAT registered, but most companies tend to be VAT registered, which isn't come across. So that's about the price for a cash-only members liquidation. And again, we're doing actually the creditors' advice liquidations from a similar sort of figure. So we are, for a small company with no assets, we are doing £2,000 start to finish of a creditors' advice liquidation. So again, it might just give an option for some smaller clients you might have, where perhaps your local practitioner's quoting £4 or £5 for it, but it gives an option for them to do that rather than having to overpay in that situation. And that, oh sorry, my question?
Yeah. Could you explain why people would go through that particular process?
The members liquidation, or?
Through the members.
Yeah, so basically...
I'm not doing why I used to do the old 652.
Since there was the extra statutory concessions order, 2012 I think, wasn't it? And basically, so it said that anything more than £25,000 coming out of a company as reserves to the shareholders now will not be eligible for capital tax treatment. And that's the big difference. I guess it's me losing my limited tax knowledge, but if you don't get capital tax treatment, you can't use entrepreneur's relief. And so if there's more than £25,000 left in there, they're going to get the benefit of entrepreneur's relief, which I think is the big draw for most people for looking at this in comparison to doing that. So it's that £25,000 figure that's cut off there.